Hey everyone, Kansas Loan Man here, and what is going on with the housing market? That's what we're going to talk about today, from Fannie Mae removing credit scores to 50-year notes to portable mortgages. What is going on? We're going to listen to this and some really good things I think you're going to want to hear today. Check this out.
What's up, you guys? It's Graham here, and just when you thought things couldn't get any crazier, buckle up. Starting soon, the mortgage giant Fannie Mae will be getting rid of their minimum credit score requirements to buy a home, at the same time that the Trump administration floats the idea of creating portable mortgages, meaning if you previously locked in a loan for 3%, theoretically you'd be able to take that loan with you to your next home, potentially unlocking hundreds of thousands of homes that otherwise never would have hit the market. That's why we need to talk about exactly what's happening, the impact this is about to have on the entire housing market, and the truth about whether or not we could actually see portable mortgages, because if we can, it's going to create some big winners and some even bigger losers. Although before we start, if you enjoy videos like this where we just cover the unbiased facts, it would mean the world to me if you hit the like button or subscribed if you haven't done that already. I know it seems dumb to ask, but it truly does help out tremendously, and as a thank you for doing that, I will do my best to read and reply to as many of your comments as I can. So thanks so much, and also a big thank you to the Gemini credit card for sponsoring this video, but more on that later. Alright, so first, let's talk about the one that will have the most immediate impact in the housing market, going into effect officially, by the way, on November 16th, and that would be no minimum credit scores. As a bit of a background, all of this begins with what's called Fannie Mae and Freddie Mac. And even though they sound like a rival rap duo, they're actually a federally backed mortgage company.
This is spectacular. Now, this is already in place, obviously. So this video is a couple weeks old. And I actually am doing a mortgage right now for somebody who has under a 570 credit score. Here's the truth on this, though. You have to have mad assets, liquidity type of assets, retirement, 401k, IRAs, some type of retirement asset. And you also have to have a substantial amount down to be able to access this program below, say, a 620 or a 600. When you get down into the 500s, all the stars have to align. Oh, we're actually going to be selling a house in this one, and they're going to be taking a large chunk of the money that they're getting from this house, from the liquidity they've gained over the last 5 years because of the housing market kind of acting crazy and prices going wild. And they're going to use that along with the assets they already have to qualify, and it's pushing them into an approval with about 40 to 50% down. So it's an amazing program for those who actually fit into it, but it is very niche-y, very, very niche on how that's going to work. Now, he's going to talk about some other stuff about the housing market. This is going to be, it just sounds crazy. Listen up.
Who buys and guarantees loans made by lenders and banks. See, anytime someone wants to buy a one-bedroom, one-bathroom home in San Francisco for $2 million, they go through a bank or a lender, allowing the buyer to be able to borrow most of the purchase. However, what most people don't realize is that when you get a mortgage from a bank, the bank isn't the one that actually holds onto it and then patiently waits for you to pay it back over 30 years. Instead, banks usually package all of their loans together into one giant basket, and then they sell that bundle off to investors as mortgage-backed securities while making a small profit in the process. This is why most banks have universally accepted mortgage requirements that you have to follow, like a minimum income, minimum amount of debt, or a certain credit score above 620, which is actually going away soon. Okay, we'll talk about that point in a moment, but because investors aren't always out there clamoring to buy these mortgage-backed securities, in 1938, the government created a backstop to guarantee to buy those mortgages if they meet a certain requirement. And by doing so, they created Freddie Mac and Fannie Mae. And this is where things get very interesting. Over the last few years, Fannie Mae and Freddie Mac have been increasing the amounts that they're willing to finance, having raised their loan limits from $500,000 in 2020 to now as high as $1.5 million if you want to purchase 4 units. The thinking here is that home prices have gone up. This makes it easier to qualify for those larger loans. It expands the pool of buyers who are able to qualify.
Now, I'll make a comment here because that is absolutely 100% true. And the reason is because if you get above a certain amount that they're not willing to finance, and we're talking about Fannie and Freddie and nice little definition of background he gave of those entities that are in place right now, which, by the way, used to be private and are now government-sponsored entities. makes it kind of interesting, doesn't it? Because there's government loans, which are FHA and VA and those kind of things. And then now we've got Fannie Freddie, which are government-sponsored entities as well. So who's really owning this whole thing? But that's another story for another day. However, they've raised this because if you go above that, you have to have 20 to 30% down. It becomes a commercial style loan, which does not do 30-year fixed. Technically, it's usually a 20-year amortization. It's usually even on a 3 to 5 year arm. So for them to do that is an exceptional opportunity for most people who can buy a home. They'll be able to put their house within these conforming loan, conventional loan limits that Fannie and Freddie will accept. Now listen up, here comes some more good stuff.
For those loans. And now this is the part that's beginning to worry people. No minimum credit score. Like I mentioned earlier, starting November 16th, Fannie Mae will no longer require a minimum credit score of 620. And I quote, "This is designed to expand access to mortgage credit, particularly among borrowers with so-called thin credit files or non-traditional credit histories." On top of that, they're also going to rely on their own comprehensive analysis of risk factors to determine eligibility. Now, in terms of what risk factors they look for, the home builder Pulte said that our underwriting standards are the same, and that they can now look at alternatives to your credit file, known as a Vantage score. This looks at your payment history outside of your normal credit profile, and it might include things like your rent payments, utility payments, phone payments, and anything else that might not show up. And the way they see it, this would allow a lot more borrowers to qualify who otherwise would have been left out. Like, just imagine that someone's been paying their rent on time, utilities on time, their bills on time for over a decade, but they just got their first credit card, and because it's so new, their credit score shows as 600. Well, prior to this new rule, they would have been left out, despite being an otherwise great borrower. But now, they could be included to get a mortgage as long as they meet every other criteria. Basically, this doesn't mean that lenders are removing the risk entirely or giving loans to anybody with a pulse, but it does mean that they're no longer reliant on credit scores if everything else looks good. So what's the risk? Well, in terms of what I think, this isn't a surprise whatsoever, because lenders have been doing everything they can over the last few years to issue more loans and bigger loans, like increasing loan limits and allowing prior appraisals to be used in loan approvals. So it makes sense that they're getting rid of the minimum credit score requirement in favor of being able to use alternative data. From my perspective, this doesn't necessarily mean that banks are going to be giving money to people who otherwise can't pay for it, but it does tell me that enough people were getting disqualified that lenders wanted to change the rules to be able to push more people through. So is this starting to become a repeat of 2008? How will this affect the housing market? And
this is what's really happening with this credit score boom. That using alternative credit to help you qualify, you still have to have the automated approval to push this thing through, which is it's tough to get with what we're talking about here on that score. And like I said, I am a loan officer. I am doing one of these less than a 600 FICO credit score type of loans. And you just have to have everything aligned. Is it going to open up opportunity for borrowers that couldn't buy before, that are actually really good borrowers and actually really good risk because they bounced down? Yes, it is. It's not going to let anybody do this. You still have to have good history. You are going to have good rent history. As far as other payments and phone bills and things like that, it's possible to use those as credit as well to do that. Honestly, though, that's a pretty big blanket statement out there. The truth is, the stars still have to align for you to buy under that point, but it does allow us to take a look at more people and have more opportunities for you if you have that kind of a credit score, but you have other things going for you. There is a lot of people that can't touch their retirement. They have a 401k. They have things, they may not be able to pull it. They don't want to pull it, but they've struggled because of external circumstances. Maybe it's a two-income household and one of the partners has a low score, the other one has a higher score because of things that have happened, or maybe they've just joined household, they have a blended household, so to speak, and you're not sure where you stand with that. It's for that kind of a borrower where we potentially have a very strong borrower on one side and maybe a weak credit score borrower on the other, but they have assets, they have money down, they have compensating factors that allow this automated approval, which still has to say yes to you, come on through on this. You know, the other interesting thing I want to touch about this, and he barely mentioned in the front as far as 50-year mortgages, portable mortgages, and the Fannie Mae credit score, I want to touch real quick on the portable mortgage. We're going to do another video on this another time, but I want to touch on this real quick. Do you realize that you could assume, and everyone's talked about this in the past, and it was a buzzword there for a while, you can assume someone else's mortgage, if it's a government mortgage like FHA, VA, at that low rate. However, you have to have the difference between what they owe on that loan and what you're buying the house for. So you have to have a large amount down. If they've got 20-30% equity in a $400,000 house, you have to come up with that difference of $100,000 to make this thing work. So you either have to have that money or you have to get a second mortgage to go on top of what you're getting with this low rate, and it offsets what you're trying to do. Now, these portable mortgages, anybody who's coming from one house going to the next, if they're making a windfall of cash out of this, it's potentially possible they could carry that. But if you're going from a $300,000 to a $400,000 house already, and you only owe $200,000, you somehow, with this portable note, have to come up with the difference between what you've got on a loan and what you're going to pay for this house. So again, it comes down to, and this is why I brought it in, it comes down to having a very large mass down payment to be able to do this type of a loan, to be able to do a portable mortgage. Just like with this credit score, if you don't have that score, you have to have a mass amount of money for a down payment to actually push this through the automated system. And that's just how it works. Real life, real talk, for real. That's what we've got to do. This portable mortgage is going to work the same way, where you have to have a second mortgage, and it offsets this low mortgage, having the second with a higher mortgage. So is it really worth it? Is it really something that could be realistic in the near future? These are all speculated things. The only thing that has happened so far is Fannie Mae releasing that credit score and allowing yours truly to actually put someone in a home who is self-aware about their situation and so excited to be able to buy a home without that credit score. So there's going to be some great opportunities coming up with the housing market doing what it's doing, and we don't know what the heck is going on with it. All I know is right now houses are being listed and left on the market longer, getting fewer offers, fewer buyers in there, because people are just kind of tired of rates. They're kind of tired of what's going on. They're tired of having to overbid or underbid or feel like they're not being able to find what they want. So the market has shifted where this is a great time for a buyer to step in, especially with this Fannie Mae no credit score. If you've got some money to put down, if you're selling a house to go to the next one, if you're blending a house and selling your two houses or one of them and going to the next one, this could be a great thing for you. So I want to get this out there and let you all know that there's some good things going on in the housing market. And I still think this is a great time to buy a home. Thanks everybody for listening up. We'll have more stuff coming in the near future. Kansas Low Man out.